Picture this. You wake up, your phone works, the lights turn on, the internet is fine, but your payment doesn't go through. You try again. Transaction pending. Coffee shop? Card declined. Gas station? System down. Your salary? Delayed. Nothing exploded. No war, no blackout. Money just stopped moving. And here's the uncomfortable truth most people never hear. When money freezes, society doesn't collapse all at once. It fractures quietly, in a very specific order. Today, we're walking through that day, minute by minute, system by system. Not a theory, not a movie. This has already happened, just not everywhere at once. We need to clear up one thing. Money isn't paper. It isn't coins. And it definitely isn't numbers in your bank app. Money is movement. Every time you buy something, pay rent, get paid, or invest, money moves between accounts. Millions of tiny promises being settled every second. Underneath your smooth little tap-to-pay moment, there's a massive plumbing system. Banks, clearinghouses, payment rails, settlement windows. Think of it like blood circulation. If blood stops moving to your finger, the finger goes numb. If it stops to your brain, everything shuts down. Now, here's the key idea. Most financial crises don't start with money disappearing. They start with money hesitating. So what breaks first? Not stocks, not crypto, not even banks. It's trust between institutions. Banks don't move money instantly. They promise to settle later. If you pay today, we'll clear it tomorrow. If you send funds now, we'll balance it by end of day. The moment banks stop trusting each other's promises, they stop letting money flow freely. This happened in 2008. Banks didn't know who was hiding bad debt, so they did the safest thing possible. They stopped lending to each other. The result? ATMs still worked, cards still swiped, but behind the scenes, the pipes were clogging, like a city where water pressure is dropping, but taps haven't gone dry yet. Most companies don't operate on cash. They operate on timing. They pay suppliers in 30 days, employees every 2 weeks, rent monthly. If payments slow down even slightly, tension builds fast. A trucking company doesn't get paid on time, so it delays fuel purchases, so delivery slow. So shelves start missing items. Not empty, just thinner. This is where the irony kicks in. The world doesn't panic when shelves are empty. It panics when shelves are almost full, because almost means uncertainty. Now we hit the most emotionally explosive point, payroll. Most people assume companies have piles of money sitting around. They don't. Many large companies hold weeks of cash, not months. If money movement slows, payroll becomes a question. Not because businesses are evil, but because timing is ruthless. When people hear your pay might be delayed, behavior changes instantly. Spending stops. Subscriptions get canceled. Restaurants go quiet. This isn't fear, it's instinct. Money stopping doesn't make people angry first, it makes them cautious. And caution spreads faster than panic. Here's where people expect the government to step in. And it does, but not how movies show it. Governments don't fix frozen money by speeches. They fix it by becoming the buyer of last trust. Central banks inject liquidity. They lend to banks. They guarantee settlements, basically saying, move the money. If someone fails, we'll absorb the damage. This sounds powerful. It is, but it creates a strange side effect. The system survives while the cost gets hidden. Debt grows quietly, risk gets postponed, and the real damage moves into the future. The crash doesn't disappear, It just changes its calendar date. Here's the absurd part. During major financial freezes, stock markets sometimes go up. Why? Because investors believe help is coming. So while workers worry about paychecks, markets celebrate liquidity injections. Same event, two realities. That's not corruption. That's how incentives work. Money doesn't move based on morality. It moves based on confidence. So, what actually breaks first? Not banks, not governments, not markets. It's assumptions. The assumption that money will be there tomorrow. The assumption that timing doesn't matter. The assumption that systems are automatic. Once people realize money movement is fragile, behavior shifts permanently. More cash buffers, less trust, more hedging, more fear of delays. That's why even after crises end, the economy never snaps back cleanly. Something invisible stays damaged. Confidence. Money doesn't need to disappear to break a society. It just needs to hesitate. A few delayed payments, a few frozen channels, a few moments of doubt. And suddenly, everyone realizes the same thing at once. We don't live in a money system. We live in a trust system that uses money to keep score. And the scariest part? You won't hear the day money stops moving. You'll feel it.